For people who don't know Agripath, we are actually based in Tamworth, and a lot of what I'll be talking about today is being gleaned from our data sets, which we collect from our clients, our farming clients across the Northwest and Liverpool Plains regions. They participate annually with us in benchmarking groups, and our role really in that benchmarking group is actually to help farmers understand where they sit in terms of universal performance, and I'll share some of that with you today, and put your data into a format that allows you to make better decisions going forward. And we'll talk about some of the consequences of our findings as a result of that as we go forward. My key messages for today, that really, for those who've heard me, it hasn't changed. There are great opportunities for individual farms to improve their performances, and when we look at the data sets across the region, we can see that the difference between the top performing farms and the average farm provides a lot of opportunity as growers to actually glean a lot more out of your businesses in terms of performance and profit over that period of time. One of the things that is key to underpinning high profit is margin, and we'll particularly talk about how important it is to be focused on producing a high margin business, and also the traps that we often see too commonly when we're looking at farm performance is that a lot of farmers are locking themselves into what we call low margin businesses purely through the decisions that they make, and we'll talk about that. I think in an environment where we are, one of the biggest opportunities as growers to improve our performance is to actually capture higher yields in high plant available water years, and we'll look at some of that data. And I think underpinning what makes good performers generate high farm profit is that they understand the environment they're working in. They understand the constraints, they understand how big their bucket is in terms of the water that they have available to them, and they understand how they can use those resources that they have available to them to build a really resilient and profitable farming system over that period of time. We'll talk about what some of those issues mean. And it's really management that sets those top performers apart. And one of my key messages today is that if you're looking to improve performance, you really need to surround yourself with a good team of people that can actually help you get the most out of your business going forward. As I said, the basis of some of this work is a GRDC funded project, which was the integration of technical data and profit drivers for more informed decisions. It essentially encompassed an analysis of profit from over 300 farms across Australia, so including Western Australia and southern New South Wales, Victoria and South Australia. And we were looking not just at 1 year's set of data, but looking at farm performance over 3 to 5 years. Agripath's involvement in that data set was to focus on the northern farms, so north of Dubbo through to central Queensland, and just looking in our data sets in terms of what we can learn from those guys that are those businesses that are consistently performing at the top of their peers over that period of time. It was to look at what are the profit drivers, so what are the things that they're doing that drives profit, and what are the technical considerations that they've taken into account to achieve that outcome, and how we can use those issues and those learnings to make more informed decisions going forward. So what is the profit potential? What we have here is a data set from our northwestern New South Wales data set. Ranging on the side here is what we call return on assets managed. Return on assets managed is the operating profit, which is calculated as the gross income that the business has generated for that production year, and we're deducting from that what we call the direct costs, or those costs that the business has incurred to generate that income. So that's things like seed, fert, chem, but also includes allocations for machinery and labour that have been applied to those different enterprises over that period of time. And we're deducting what we call the farm business overhead, which is things like your rates, bank fees, all the costs of running a business that are pretty much steady state for a year over that period of time. That equals the operating profit. That's put back over the assets that are actually managed in the business, that being land and machinery and livestock and water. And in this case, we're looking at primarily farms that 70% of their income has been derived, or more has been derived from dryland grain farming over that period of time. So each one of these red lines represents a farm business in the data set over 5 years. The black dots represent the average return that those farms have achieved over that 5-year period. So the top performing farms up here are giving returns of around 10% return on their assets managed. In other words, if they had a $10 million asset, they're generating about $1 million worth of profit before interest, tax and capital improvement over that period of time. And the red lines around the black dots represent the range of returns that those farms have experienced to get that average return over the 5-year period. You've got an average in the group of about 6% return on assets managed over a 5-year period. The top performing farms are running at about 10% over that 5-year period, so we have a difference of 4% return between the top and the average farm in that group. Now, if you think about the assets that have been managed, the average asset in that group is around $20 million. So we've got a difference between the top performing farms and the average farms there of 4% on a $20 million asset. It's $800,000 a year difference in profit between the top performing farm and the average, without even thinking about the farms that are down on the bottom end of the scale. And one of the things that we typically hear and see when we're sitting down in front of our clients is saying, well, how can that be? I'm growing the same sorts of crops, I'm getting the same sorts of yields and the same sorts of prices. How can there be big differences in profitability between what my business is doing and what other businesses are doing? So we need to understand what those drivers are. And probably more importantly, when we look at that sort of data and start to say, well, if we're giving up $800,000 a year on average per year, and we do that over 5 years, it's $4 million for an average farming business in that part of the world. In the Liverpool Plains region, the sums are very similar. Those that are in the room that have participated in our benchmarking understand those sums pretty clearly about what it means for them empirically, but also what it means in terms of using that additional profit to help them do the things that they aspire to do. So they are things like succession, paying the debt back, buying the holiday house, doing the overseas trips, those sorts of things, buying the next door neighbours. That extra profit is the thing that makes the difference between the top performers and their ability to go out and acquire assets and do things and grow their businesses compared to some of these other businesses that sit in the data set over that period of time. I think the other important thing for us as individuals and farmers is that the truth is that we've probably only got about 40 crops in us in a lifetime as a farmer. So if it takes us 35 to work it out, we've actually given up a lot of opportunity. So that's part of the challenge I see, and one of our key messages is make sure you have good information around you to help you make decisions going forward. Otherwise, you're giving up a lot of opportunity as we move forward over that period of time. So let's understand what does that actually look like in empirical terms across the data sets. They were split up between North East and South East New South Wales and South East Queensland, which is sort of your region. We're looking at the top 20%, an area crop, actually not farming as much as some of the average farm, but generating 7% over that 5-year period. Average gross margin was $412 compared to $265. After overheads, talking about $321 a hectare profit compared to $178 for the average farm. So nearly double the profit between one farm, what the top performers are doing, and the average farm in that region. And when we go to the western areas, so this is sort of Western Moree and the Western Downs area and around Walgett, again a doubling profit between what the top performing farms are doing and the average, and up in CQ a double of profit. So the story is the same, and certainly if you go down to the south, it's the same story. There's this huge opportunity between the average farms and groups and what the top performers are doing. So what is it that we need? What are the considerations we need to take if we want to build a profitable farming system? And what we know from when we look at the data sets is that top performing farms really know their metrics. They know the metrics of their business in terms of what drives profit out of it. So it's coming back to being as simple as understanding soils. What the plant available water capacity, that's PAWC, what the plant available water capacity, what it physically can hold in it, what constraints might be there and how they impact on crop performance, and what level of fertility is sitting in those soils over that period of time. Now that's really important to understand your soils, because one of the things you'll see later in my talk is that the decisions we make about how full that soil is and when we choose to plant a crop and when we choose not to plant a crop can have a big impact on it. And one of the things we do know, particularly if we're west of the Newell, where water is more and more limiting, is that if we look at the amount of rainfall that we accumulate over a fallow period from one winter crop to the next, we're accumulating about on average 80 mils of starting moisture in our soils between one winter crop and the next. But that also means that 50% of the time we're actually going to start with less than 80 mils, and 50% of the time we're going to start with more than 80 mils in that profile. And it's the decisions we make about how we react to that information and what we do with it that has a big impact on profitability over that period of time. And there is a real danger in just putting the crop in for cropping's sake, because we've got to meet an interest bill and we've got to pay the boarding school fees and those sorts of things. The natural temptation of managers is to put a crop in. But sometimes by making those sorts of decisions, we actually lock ourselves into really low margin type scenarios, which affect our profit this year, but also the next year and the year after. So it's about understanding that. It's also about understanding what is it about our climate. And one of the things that we typically see from producers is say, well, we put a crop in and this happened, it didn't rain or it didn't do that. What I think the discussion should be about is to say, we understand about our environment, we understand our soils hold this much water, we understand that it takes this long to fill the profile. So if we're in the Gunnedah area, between one winter crop and the next winter crop, we basically on average accumulate about 120 mils of moisture in the soil on average, and yet we're doing that on some soils that can hold 240 mils. And it's what we do with that information in terms of how do we derive profit from that information, in terms of is it appropriate to pull the trigger when we've got it half full, or should we fill it up more at a later date for a crop down the track that may be more profitable as we go forward over that period of time. So it's really about trying to understand those, the other constraints that go with that in terms of how much rain we accumulate in the fallows, when our frost dates are in those environments, teaming that up with the agronomy, so understanding, importantly, how do we use these base assets that we have to get the best out of it in terms of sowing windows, in terms of varieties that we use and crop choices over that period of time. Getting the technology right on the farm in terms of whether it's appropriate to use different pieces of technology in terms of how we get fertiliser out, where we use controlled traffic, those sorts of things are important components, and how we deal with the people. And there's a session on dealing with people that I'd encourage you to have a look at later on in the day. And then combining that with what we know about the markets. What are the price signals? What's the supply look like? What the demand looks like? What are the price signals for us? And how do we use that information to make choices as we go forward? And ultimately, using that information, that technical data, to help us evolve and make decisions that will enable us to have a very resilient farming system that responds to the environment that we're actually working in over that period of time. So when you look at that, I would say there are four main profit drivers. The first is to focus on having a high margin business. Some people like to call it gross margin optimisation. I think in our part of the world it's about high margin. I think we are in an environment where our upside yield potential is so high that we need to make sure that we're putting enough into the crops to capture that. We'll talk about that a little bit later on. But underpinning that is this need to run a really low-cost business model, which is about getting efficiencies out of labour and machinery and scale into the business over that period of time. How we deal with the people and management, we'll talk about that. But ultimately, my message for you today as managers is, one, we need to make sure that we can manage our staff well, and secondly, we need to surround ourselves with really good people to help us in terms of driving the business forward. And then how do we deal with the risks that are associated with the business? For most of us, that's climatic and some financial risk in terms of debt that we carry in the business over that period of time. So how do we understand what are the key performance indicators? So this is the same set of data that I put up before. The blue columns now, the blue columns now represent the black dots that we looked at before for each of the businesses as the average return. So the top performing farms are running at a 10% return on assets here, and the profit drops away as we go. This top line here just looks at how well those farms are generating income as a percentage of their asset base. And we can see that in that part of the world, that to be a top performing farm, we need to be generating about 25% of the asset base as income. Here in the Liverpool Plains Gunnedah region, that number's probably more like 20% because of the higher land values that we have over that period of time. And as we move from high profit to low profit, the income generally drops, but not always, as a percentage of the asset base over that period of time. So what drives income? So for a lot of businesses, if we're not achieving better than 20% income ratios on our asset base, then we need to focus on the things that drive income. What drives income? If we've got a $10 million asset, we want that to be better than 20% of the asset value. So we're looking at an aspirational income target for a $10 million asset of about $2 million. What are the things that drive it? They are the choices we make in terms of crop selection, how we integrate that into terms of a crop rotation and the frequency that we do that at. It's how well we set our crop choices that we make up for yield, and that's primarily dictated by soil water, plus the rainfall in crop, so that plant available water component, and how well we've got our agronomics right and husbandry right to get optimum water use efficiency out of it, so we're getting the highest yield potential that we can out of the asset. And then how do we respond to these price signals that we have in the environment that we're actually working with? So we're always working with this dynamic in terms of how do we maximise income in that environment. It's in that matrix that we're dealing with some of those issues going forward over the period of time. So this second line says, well, that's all good, Simon. I can go out and produce income, but if it costs me a bomb to do it, well, it's not much value to me. So the second line, the green line, represents how well we convert that income into margin. All right, so this is after we've spent the costs to generate the income. So we spend the seed, the fert, the chem, the machinery costs, the labour costs to generate that income. And again, we can see, and one of the reasons we talk about high margin businesses is that that's highly correlated with the return on assets managed, the blue columns there. And the top performing businesses in this environment are converting more than 10% of their asset value, or 50% of their income, back into margin over that period of time. So their gross margin ratios are above 10%. And again, as the returns drop, so does the gross margin ratio in that business drop over that period of time. So that tells us that for a lot of businesses who are generating high income, they're converting that quite well in margin. But as we look through the data sets and we think, why are there big differences in profitability between one business and another, we can see that over here we've got some businesses that are actually quite good at generating income, but they haven't converted it into margin. So what is that telling us about those businesses? Is it income that's their problem? What's their problem? It's cost. It's the margin. It's the cost, their conversion. So it's their direct costs are the issues. So we can go and have a conversation all day about income in those businesses. They'll have the same sorts of yields and be growing the same sorts of crops, growing the same and getting the same sorts of prices as their peers. It's the cost structure of their business that's pulling them back as they go forward over that period of time. So when we're talking about cost structure, we're really looking at what we call these direct costs, which are the ones that we're most familiar with, which are seed, fuel, those sorts of things. But we also have these other costs that we don't think of as much, which are things like machinery costs and the cost of your own time in terms of labour and those sorts of things that come into the business, into the play of the business over that period of time. The final line here is the blue line, which is what we call the overhead cost line of the business. So it's looking at the percentage of income as a percentage of the overhead costs. And again, we can see that generally the top performing farms have overhead cost ratios of less than 10% of their income over that period of time. And that for some farms, even though their performance is quite good, overhead costs become an issue for them. So that's about the structural costs in the business. And typically that happens when we've got more than one generation at home in a business, and suddenly we're supporting 2 families and 3 families in a business. And we need to be aware of those costs in terms of how we're going to deal with them, in terms of can we use our resources and other ways to overcome those costs, because they do build up quite dramatically over a period of time. So when we talk about overhead costs, we're really talking about utilities, those sorts of things, bank fees, but all the other stuff that comes with running a business, like vehicles and overhead time and those sorts of things, and allowances for vehicles and base kit for a business going forward over that period of time. All right, so one of the challenges I said, or one of the things I think is really important for us, and what the top performing farmers do is that they run high margin businesses. If we think about those ratios that we put together and what they're doing over that period of time, what we're actually aspiring for a business on the Liverpool Plains is a gross margin ratio that's above 10% of the asset value. So if we've got $7,500 a hectare of asset in land and machinery associated with farming, it's meaning to achieve a gross margin ratio of 10% on every hectare of cropping land that we have available, we need an aspirational gross margin target of about $750 a hectare at today's values across every hectare that we farm. And that's despite whether we choose to fallow that or crop it or double crop it or whatever we do. Aspirationally, that's what we need over that period of time. These are the dryland crop gross margins for the Liverpool Plains for 15-16. We haven't collected the 16-17 data yet. We'll be doing that shortly. $750 sits about there. And when we look at the crop choices, we can see that the orange lines represent what the top 20% did in that year, and the blue lines represent what the average of the group did in that environment. So it actually presents quite a large challenge for us to maintain business performance and margin over a period of time at those asset values. And we can see that canola on long fallow's done quite well, and both bread wheat on long fallow and durum on long fallow have met that aspirational target. Chickpeas on short fallow have met it with the top performers, but wasn't met by the average farm in the group. And so did chickpeas on double crop, sorghum long fallow did it, and cotton on long fallow met that aspirational targets over that period of time. So the sequence of crops. Sorry, yes.
Sorry, Simon. Your long fallow budgets, are they over an 18-month?
Yeah, so that's an accumulation of fallow costs and machinery and labour costs to actually make that happen.
Your short fallow budgets, though, are a crop every 12 months,
yes.
Right? Your long fallow budgets are a crop every 18 months.
Yes.
So are your gross margins then compared on a 12-month basis, or is it just taken at
It's
time?
taken the full cost associated with the crop. So to look at that, you're quite right to look at that. It's saying if it's on long fallow, it's achieved 750, but I've had 2 years to do it. So you have to halve it in terms of that component.
Right, that's what I was getting at.
Yeah.
Thank you.
So that's the first challenge. So it's what we do with that, and remembering that crop sequencing is also a very important component. So one of the great things about a long fallow, short fallow sequence with sorghum or cotton is that potentially we can double crop it to chickpeas. And if we line that up with a short fallow sorghum in that environment, which has just escaped me, and put a double crop chickpeas, which is this one here behind it, then we can actually put quite a big margin together in a 12-month period. Remembering that it's how we deal with the resources available to us that will drive the profitability of the business. So what we do know is that we have these buckets we've got to fill up, and it takes time to fill those up because we technically don't get enough rainfall in 1 year to fill a profile that's over 200 mils in that environment at 25% fallow efficiency.
So when you look at that, when you look at those figures, we can make good money sorghum, long fallow, double crop chickpeas.
Yes.
If we short fallow wheat back into that, we're going backwards.
On that year's data.
So
yeah,
you know, we need the wheat to generate the cover to grow those long fallow sorghum. So you know, sort of what's the average over the rotation?
Yeah, so what we do know is when we put all that together, the top performers manage that sequence of cropping to generate margins above $750 a hectare on every hectare, and that's the challenge individually. And I think the only way you can understand that for your own business is actually measure it against like-for-like peers so you understand what's going on and learn from what other people have been able to achieve in that environment. So the other component of it is we need to be focused on yield, and yield is king. It will help drive margin, there's no doubt about that. Highly correlated. These are long fallow and short fallow yields in the same year. Top performing farms achieving around 8 tonne to the hectare on dry land from their sorghum, which is generating $800 plus a hectare margin in that result. And as the yield drops away, so does the margin. So that has a big impact on our ability to achieve that aspirational $750 a hectare from our crop over that environment through that period of time. This data here came from the Closing Yield Gap project that Agripath did for the Northern Grains region, and essentially what we did here was take our top performing farms over 5 years and any of the better the trial data that are out there, like the national variety trial data, that had good water use efficiency data and was growing in pretty good growing conditions to try and maximise yields over it. And it's looking at plant available water across the northern grains region, which includes the soil water at sowing plus the in-crop rainfall, and looking at the spread of yield and water use efficiency that was achieved over that period of time. What I think we got out of that data was that in low rainfall years, it's hard for us to maximise water use efficiency. We are constrained by Mother Nature in terms of water, but what we are seeing is a large spread as our plant available water levels get above 350, 400 mils in that environment. We're seeing yields go from 3 tonne, because it's got too wet or disease or weeds have picked in, up to well over 6 tonne per hectare. And I think the challenge for us in the growers, and we experienced this last year, was we actually had about a 600 mil plant available water year last year. Now, if I'm an irrigation farmer down in the MIA where I can control that water, and when I put it on that crop, I would expect a 10 tonne to the hectare yield as a result of that outcome. Now, granted, in a 600 mil rainfall, we can't choose when that water came to us, but I didn't see too many at 7 or 8 tonne to hectare yields. There were a few paddocks that did it, but I didn't see that across the farm. So I think that represents an enormous opportunity for us to work out ways that how do we capture that in high rainfall years, and what are the things we've got to do with our resources. Does it involve elements of drainage? Does it involve elements of extra nutrition? And being prepared to back ourselves to get those high yields in that environment over that period of time. So something to think about. So I think we leave a lot on the table in these high rainfall years, and that's what the data shows us. What's an extra 20 mils of moisture worth? Most of the time we're struggling to get enough moisture in an environment. So what is an extra 20 mils of moisture worth to us? And again, this is one of the things that we see top performers are very religious about, trying to capture as much moisture in their fallows as they possibly can. This is some analysis that was done using Apson model, but we've been able to validate with some of our own yield data and things in it. And it's, the way that we've done it is look at 2 different soil types, one that holds 150 mils and one that holds 180 mils over. And we've looked at that and run Apson on it for over 100 years. And the idea being that sometimes this profile here will be full, and which means that this other profile here will actually have additional moisture available to it that this profile won't, because it runs off. Does that make sense? When you run that over that period of time, you get on average over 100 years, the difference between those 2 profiles, 22 mils extra in this profile as a result of it, of plant available water, which gets converted at about 24 kilos of water use efficiency compared to around 12 on average for the whole crop over that period of time. So that additional moisture is adding about half a tonne at 24 kilos of water use efficiency per millimetre. So just a small amount of water is providing a high level of efficiency in terms of water use efficiency and additional yield as a result of it over a period of time. When you look at that in terms of margins, that could be the difference in a dry year of 2.5, which is what we've sort of experienced in some years, and a yield of 3. And on current costs and things in that environment, it means that we can over double profit in that environment. Still not great from an aspirational point of view, but significantly better than $70 a hectare. And if we look at it from a wheat point of view, an extra 0.4 of a tonne is about a 70% increase in margin available to our businesses. So the question there is to say that when we're getting behind in the spraying in the summer, how much is it worth to get an extra contractor in to get on top of those weeds? What is it worth to you over that environment, over that period of time? And I think that's one of the things that top performers do quite well, is that they get on top of their fallows, because they realise what the value of this extra moisture is over a period of time. We talked a lot about management and risk and the choices we made. One of the issues we typically see, or we at Agripath probably call the greatest sin in farming, is that growers make decisions that actually impact on their business and actually lock them into low margin over a period of time. So the decisions we make now are actually locking the business into low margin. And so they're decisions about how we're using starting moisture that may not be desirable, and what decisions we make around that. And I want to talk a little bit about that now. So this is some example from our Eastern farming data set in northwest New South Wales, and it's looking at cotton in 14-15 that was sown in the summer of 14-15, and sorghum, which was sown in 14-15 in that summer as well. All right. These blue dots, the X's here, which you can just see, represent the average return in that data set that was achieved by both of those crops in that environment. You can see they're not that great. Cotton was about 350 and sorghum was about 250 a hectare in that environment. The blue columns, the boxes, represent 90% of the data was covered within that box, and these other extras are outliners. So we can see that we had some terrible results, and the best result was about 600. The best result for sorghum was about 700, but we also had a negative $250 for sorghum. Majority of it lay within just under $500 and $100, cotton at $600 and about $200 over that environment. The next boxes look at the result of the following chickpeas, which were double cropped into that cropping country over that period of time, and we can see that sorghum being an earlier finished crop, the chickpea gross margin was higher for double crop after sorghum compared to cotton, and then the two boxes next to that are the combined results of the two crops for the year. So basically we've achieved nearly $1,920 a hectare out of the cotton double crop chickpeas, and we've achieved just under, I think it was $990 for sorghum double crop chickpeas in that environment. So we'd say, well, that's quite a good learning. We've done a lot of work in that environment. But the thing is, these next two boxes look at the farmers that said, you know what, it's actually too dry. I don't have a full profile to grow cotton or sorghum in my environment. I'm going to wait for a more profitable opportunity for my business going forward. So that's the result of long-fallowed chickpeas. Instead of going to cotton or sorghum, went to long-fallow, and it's achieved a margin of just on $980 odd a hectare in that environment. And favour beans in that particular year with a better price were up around $900 a hectare in that environment. Now, to achieve that margin there of $990, these guys have put up $1,000 for the cotton and $600 for the chickpeas. So $1,600 to get a $990. To achieve this one, they've done $1,200 to get $990, and to do that, they've put up $600 to get $990. So it's sometimes the decisions that we make can potentially lock us into unprofitable situations. These two examples here are for the farms that were west of the highway who had no opportunity to plant anything in that environment. So it was just too dry. If they'd planted it, it would have failed and they would have got a very negative result. They've still managed to achieve margins up around $500 a hectare because they delayed their decisions in terms of what they were going to do for a more profitable opportunity going forward. So sometimes the message, and it's particularly relevant for the Liverpool Plains region, where we tend to have opportunities to plant a lot of crops at a lot of different times of years, the message is sometimes activity does not always breed profitability. All right? We can do a lot of activity, but it's actually not generating much profit for our businesses going forward. And sometimes that activity can actually lock us into a really low margin environment and actually prevent us from actually getting a higher margin down the track because we haven't been able to store enough moisture to take advantage of a more profitable crop down the track from where we are. This is a great example of that. So this is about businesses that have said, you know what, I recognise that I'm in this environment, and for me, I know that every year from one winter crop to the next, I'm only storing 80 mils. Sometimes that means that it's going to be less than that. Sometimes it means it's going to be more than that. I need some structure in my sequence because of that environment. I need to provide some structure, which is long fallow in that system over this environment. So this is northwest New South Wales in a period in 15-16 where it was extraordinarily dry out there. So these three farms here are farms that went out and farmed everything. High interest bill, kids to put through boarding school, I've got to put it all in, just have to. Do we? Because what it showed was the result of that in a tough year, because they'd done the same thing the year before and farmed 100% of their area, their average margin across every hectare cropped at nearly 100% cropping intensity was less than $100 a hectare. So we have to deduct $70 worth of overhead costs, we have to deduct another $80 worth of interest, and that means that we're really in the red a long way as a result of it. These businesses here are businesses that recognise, I understand the environment that I'm working in, I understand that I've got this bucket that I can fill up, and that I need an element of long fallow, so they've got 20% of their area into long fallow. They have generated in the same year, almost next door neighbours, upwards of $500 to $600 a hectare compared to their peers. Nothing to do with rainfall, nothing to do with being lucky or unlucky. It's all about building a resilient business that recognises the environment they're actually working in and that they need to fill the buckets up. These are businesses that said it's too dry, I've learnt from my sins, I'm only going to plant 30 or 40%, and they had a little bit of long fallow and that's all they put in, and they've still managed to get higher margins across every hectare, even the fallow area, than the guys that went flat out in that environment. So be really aware of your decision making in terms of creating low margin for your business going forward. Here you've used up an opportunity and you're back at square one to start next year again. These guys have already got 20% fallow laid aside for the next year. I'm under pressure. So low cost business in terms of time. One of the things that we talk about is that top performers understand the structural costs of their business. They understand that to get things done it costs money, and they want to do that quite efficiently over the period of time. This is a measurement of TPML costs for that data set, and under TPML we're really measuring the depreciation that comes with ownership of plant and the R&M that comes with that, and the labour that comes with having to operate plant that you own. And we're also including the cost of contracting that you incur if you bring operations into your business. So it's basically the cost of getting things done in your business. And what we can see here is that before we put plant a seed in the ground, plant 1 hectare of grain, we have differences of over $100 a hectare in TPML costs between one business and another business, purely through the decisions they've done in terms of kitting up their business. So if you're thinking about the average farm of 3,000 hectares in that data set, $100 a hectare on the average farm is $300,000 difference in profit through the decisions they've made in terms of how they're going to kit their business up. And I would advocate that the only way you can really understand that is by measuring it and understanding where you sit in that universe over that period of time. And similarly, when we look at business overhead, one of the large challenges for small businesses is this overhead cost issue. And again, you can see the data's quite clear that for farms of similar sizes, there are large differences in overhead cost. So again, if we're looking at farms of 3,000 hectares, we've got differences here of $40 and $50 a hectare, so 150 grand in overhead costs through the decisions that they've made in terms of structurally how that business is going to be run. So again, you need to measure those components over that period of time. Finally, I want to finish on management. People often say to me, oh, well, the big farmers, they make all the money. This is at that same data set looking at that scale, the scale of those businesses that achieve. So here's our top performing farm. Here's those 3 other top performing farms up around 10% in return on assets in that environment, and they are at the smaller end of the scale. The sad bit is that they have a lot of mates, and the difference in profitability is somewhere 8% between them in that environment. What these guys have done is they've worked out the environment that they're working in. The decisions that they make are premised on understanding the metrics of their business in terms of what their soils can do and how they use that information and the rainfall available to them to actually derive profitable margin out of it, a high margin out of those environments. And they do that by putting a good team of people around them. So they're agronomists, they're bankers, they're accountants, they're business advisors, are all part of that integral position. And I think if you're a business that wants to perform, make sure you get a good team around you. You have to have people that are going to challenge you and push you to get the most out of your assets moving forward over that period of time. If you get all that right, then you get what I call our matrix on high profits from grain, which is really about some of these aspirational targets down the side here and what we should be doing and the things that we should be thinking about at each level as we go forward over that period of time. But it is quite possible, and and doable to achieve returns upwards of 7 and 8% returns on your assets quite consistently if you build resilient businesses using the technical data and the understandings that you can get from your environment that you're farming in. Thank you.